Good morning. Good morning, Sanjay. Good morning. We continue with Ind AS 101. Previous session, we saw the discussions revolving around Ind AS 101 and we covered specific transitionary guidances with respect to ESOPs and then forex and then property, plant and equipment. And I think I had left you with a homework question, which we will now see. Okay. So basically, for property, plant and equipment, you have a transition option wherein you can choose the previous gap value as the point from which you can start your Ind AS financial statement. So that is an exemption that is available to you under Ind AS 101. Parallelly, if you recollect, in terms of foreign exchange, we saw the treatment for exchange differences arising from applicability of para 46, 46A of AS 11, where you would either in those days you had an option to take the exchange differences on long-term loans to the P&L, or if you had to take the irrevocable choice, you could add it to an FCMI TDA account and amortize it over the tenure of the long-term loan, or capitalize it and depreciate over the life of the asset. So this was a choice that was available. Okay, but when you are switching over to Ind AS, you will have to mandatorily select the option of taking it to the P&L if you are in option 1 under AS 11 regime. If you are in option 2, there is a transition exemption that is available where you can continue to remain in option 2 or move to option 1. But you cannot have a scenario where you have taken the exchange differences to P&L under AS 11 and now you want to move to an option 2, that is create an FCMI TDA or capitalize in fixed assets. That option is no longer available to you. So option 2 to option 1 is permissible. Option 1 to option 1 is permissible. Option 1 to option 2 is something which is not permissible. Okay. Option 1 to option 2 is not permissible. 2 to 2 is permissible. Okay, so this was the broad treatments that we had seen. Question number 4 of your study material is something which is marrying both of them. Okay, so now let us look at how the question pans out. It's a small question. A company has chosen to elect the deemed cost exemption in line with Ind AS 101. So therefore, whatever is the previous gap value, it wants to bring that into the Ind AS financials, the converged Ind AS financials. Can he do that? Answer is yes. You have a transition guidance. However, it does not wish to continue with the existing policy of capitalizing exchange fluctuation on long-term foreign currency monetary items to property, plant, equipment. That means it does not want to avail the exemption elected under Ind AS 101. So now tell me, what is that scenario? For fixed assets, it wants to utilize the deemed cost exemption. Yes, Sanjay? Yeah. For forex. Under AS 11, it was following option 2. That means what it was doing? Capitalize exchange differences under AS 11 into property, plant, equipment. And when it is transitioning to Ind AS, they want to go for option 1. That means recognize differences in P&L. Are you okay with the question? Yes? Have you understood? Okay.
Yes.
So now, in such a case, how would the company be required to adjust the foreign exchange fluctuation, which is already capitalized to the cost of property, plant, and equipment under the previous cap? So let us take an example. Okay, same question. Suppose cost of PPE is 1 lakh. Exchange fluctuation that you have capitalized is 1,20,000. So total your PPE. When I say cost, I think I should not say cost. I will say WDV or net book value of PPE. So this is your 1 lakh plus exchange fluctuation total. Are we okay with this?
Yes.
This is what is appearing under AS level. Now they want to transition to Ind AS. Okay. Now they want to transition to Ind AS. Okay. Now you ignore depreciation and all, etc., for the time being. Okay. In that light, I think let me just keep it as cost. Will not complicate it. Okay. Now let us look at it now. Under Ind AS 101, property, plant, equipment exemption. What will be the brought forward value into Ind AS?
1,20,000.
1,20,000. Absolutely right. But now, for forex purposes, which option has he availed? Which option has he availed? AS11, he was under option 2. He would capitalize
Option 1.
the exchange differences into PPE.
Option 1.
Now he says, I will no longer do that. I want to take my exchange differences to P&L. Is it permitted? Is it permitted? Answer is yes. It's
Yes.
allowed. But if he wants to do that, if this company wants to do that, what it has to do? 20,000, which is already capitalized, this must move to retained earnings. And your property, plant, equipment will be only 1 lakh. Yes or no?
Yes.
Because you are saying, I will move everything to P&L. So if you are moving everything to P&L, what is already capitalized as a forex fluctuation, that you will have to remove from PPE and move it into retained earnings, and your then asset block will appear at 1 lakh rupees. Are we okay with this?
Yes.
Now, you can see that there is a conflict. If I comply with forex requirement and state my PPE at 1 lakh, I will end up not complying with PPE requirement, because PPE requirement says that whatever is your value, you have to bring it as your value in Ind AS, and my value is 1,20,000. Yes or no?
Yes.
And if I follow the PPE exemption and bring it at 1,20,000, then I will be non-compliant as far as the forex provisions are concerned. Yes, because there 20,000 I am capitalizing it in the cost of the property, plant, equipment, and therefore to that extent I will not be complying with the forex exemption that is there. Yes.
Yes.
It is a catch-22 situation. I hold one thing, other thing gets non-compliant. I hold the other thing, the first thing gets non-compliant. So how do we move further? So the way forward is, you view it harmoniously. You view it that these two provisions do not conflict with each other. They should mutually coexist. So how is that possible? You say that my property, plant, equipment, I will bring it into the books at 1,20,000. So I have complied with property, plant, and equipment requirements. And going forward, henceforth, all exchange differences will be taken to P&L. You will not do this transition adjustment because that has to comply with fixed asset exemption requirements. So I will bring the PPE at 1,20,000, but henceforth my exchange differences, whatever is there on the long-term currency item, that will move it to the P&L without capitalizing it. Are we okay with this?
Yes. Yes.
Yes. So that takes care of this question. Okay. So with that, I think we are closed on the property, plant, equipment side. Any doubts so far?
No, clear.
No doubts, all clear. Okay, fine. So with that, let us move on to the next special case, that is business combinations. Okay, business combinations. Now, what is the case with business combination? What is the case with business combination? Okay. See, AS14 initially dealt with amalgamation, if you recollect, and you had for consolidation AS21. These were the limited standards that we were dealing with in terms of amalgamation or consolidation. Now, AS14 spoke about acquiring a company using either the purchase method or the pooling of interest method. Are you able to recollect that? Yes.
Yes. Yes.
Okay. So now, when we talk about AS14, it was very clear that purchase consideration that would be paid by the acquiring company to the owners of the target company would be a definitive payout, and as far as AS21 was concerned, consolidation could happen only if you held more than 50% in terms of shareholding. Otherwise, consolidation would generally not be permitted, would not be permitted. You had some very limited scope of not consolidating an entity, but largely it was driven by a rules based order wherein because I am owning more than 50%, only then will I consolidate. Otherwise, I will not consolidate. So, this was your position that was taken under AS14 or AS21, whatever it is. Okay. Now, we come to Ind AS 103 and Ind AS 110. When we talk about control, here the guiding principle for consolidation is what you have already studied to be control, right? Now, is control dependent on the equity stake that I am holding? Yes.
Yes.
No, control is dependent on the definition that is there under Ind AS 110, which is the ability to direct relevant activities, which is the ability to direct the relevant activities and to benefit from the variable returns that comes on account of directing the relevant activities. Nowhere in Ind AS 110 control definition is linked to the stake of shareholding that you are having. There are two different things under Ind AS 110. Let us take an example. Okay. A company A is holding 1000 equity shares in entity B, which is basically 100% stake, which is basically 100% stake. There is another entity C. C is owning 10,000 optionally convertible debentures, convertible at the option of C. Okay, since 2015. Since 2015. Transition date, C transitions to Ind AS 1st April 2022. 1st April 2022. Okay. Optionally convertible debentures anytime at option of the holder. At option of the holder. And conversion terms are favorable. Conversion terms are favorable. Okay. Now, if I have to talk about AS21, who do you think is the parent company under accounting standard 21?
A.
A. So A will consolidate B. Fair enough. No
Yes.
discussion because I'm owning 100% share. It becomes my wholly owned subsidiary. Let us account it as such. Okay. Now, under Ind AS, who is the owner of B? Or rather, we will not ask who is the owner. We will ask who is having control over B. Is it A having control or is it C having control?
C.
C. Because there is a potential stake that he is having. With a 10,000 OCDs convertible at his option on favorable conversion terms, it's just a matter of time that he converts, right? So therefore, it is not A, but it is C that should do the consolidation. Okay. So now this is your position. Did C consolidate under AS21?
No.
No. But now C will have to consolidate under Ind AS. Yes.
Yes. Yes.
Now, when is the date of transition happening? 1st April 2022. Correct?
Correct. Correct.
But when did the acquisition happen? When did the acquisition happen?
Convertible debentures were acquired in
Yes. Yes.
2015.
Yes. So let us assume it is 1st April 2015. Now, forget Ind AS 101. Ideally, from when you should have consolidated?
2015. First of all.
2015 onwards. But I did not consolidate because I was under a different framework. I was under AS. Under AS, A was consolidating B. Under Ind AS, C should have consolidated B with effect from 1/4/2015. But when did Ind AS become applicable to me? 1st April 2022 onwards is my transition date. So when 1st April 2022 is my transition date, then ideally, let us look at the timeline now. 1st April 2022, 1st April 2015. On this date, C should have consolidated B. Did it do that? No. Why it did not do? Because it was not applicable only. The framework itself was not applicable. So is there anything wrong that C had done at that time? Answer is no. C is perfectly right in not consolidating because AS21 did not view any potential instruments. It viewed on actual position as at that point of time. And at that point of time, A was the 100% owner of B and therefore A consolidated B. Are we okay with this? Yes.
Yes.
Now 1/4/2022 is the date of transition. Let us forget Ind AS 101. On this date, when I have financial statements prepared as per Ind AS 101, should I not factor in the consolidation effective from 1st April 2015? Yes.
Yes.
Because what is this? When I move from AS to Ind AS, is it a change in estimate or change in policy? It is a change in policy. And because it is a change in policy, it will be deemed to be applicable right from the very beginning. And because it is deemed to be applicable right from the very beginning, we have current year, which comes under Ind AS. We have the previous year also, which is restated under Ind AS. And we also go back in time, and whatever modifications are there, we will pass it in the retained earnings. We will pass it in the retained earnings. Are yes or no?
Yes.
So you would have a 3-column balance sheet. That means if from 1st April 2022 being the date of transition to Ind AS, if that be the case, that means Ind AS was applicable always. That means we would have to give effect as if it was applicable on 1/4/2015. That means we would have to go back in time, find the purchase consideration in line with Ind AS. We will have to find out whatever is acquired, at what fair value has it been acquired, and that would give rise to goodwill that arose on 1st April 2015 on acquisition. And then you would do a testing for impairment till you come to the values as at 1st April 2022, not only for goodwill, but also for the overall entity. Are we okay with this?
Yes.
Yes.
Yes, sir.
Now, for academic purposes, is this easy? Yes. You will be given fair value on 1st April 2015. You will be given everything. All you have to do is put in the hard work to do the calculation. But if you look from a practical perspective, is it really practical to go back in time and do the restatement?
No, it's not easy.
It's not easy. It's not easy, right? Suppose I have similarly 5 to 7 companies. That means, will I do this activity 5 to 7 times for all entities? Answer is no. Answer is no. It's not possible. Okay. So what you have received is, you have received a relief. You have received a relief under Ind AS 101. What is your relief under Ind AS 101? You will decide to retrospectively restate with effect from a date of your choice. You will do the restatement based on a date of your choice. Okay. So therefore, retrospective restatement, retrospective restatement with effect from a particular date. Sir, should it be retrospective always? Answer is no. If you do not want to do retrospective restatement, then effective date of transition. Effective the date of transition, do acquisition accounting. That is, date of transition will be regarded as deemed date of acquisition. Are we okay with this?
Yes.
Yes. So for example, 1st April 2022 is my date of transition. And I do not want to go into the mess and change everything from past, because it's not a one-time change. You see, 1/4/2015, चलो for instance पकड़ के रखो, मैंने change कर दिया. I did a change. I retrospectively restated. Is it over then? Is it over then? Answer is no. 1st April 2015 is the starting point. आपने बहुत मेहनत की है. You did lot of hard work. You found out the fair value. You did the contingent consideration. You did the variable consideration. God knows whatever is there, all of that you have done, and determined the goodwill on 1st April 2015. Will you be sitting quietly after that? Will you be
No.
sitting quietly after that?
No.
Answer is no. 31st March 16 you have to consolidate. 31st March 17 you have to consolidate. 18 you have to consolidate. 19 you have to consolidate. 20, 21, 22. Till 22 you have to go on doing the consolidation of B into C. And that will give you the reserves balance on the date of transition. Are you able to follow?
Yes. Yes.
Yes. So a restatement is not a simple one-time activity. It comes with a plethora of future activities that need to be carried out. It's a cascading effect. So therefore, there is a relief that is given under Ind AS 101. What you can do is, you can say that I will do a retrospective restatement effective 1st April 2020. Okay, so if you say that I will pick a date 1/4/2020 as my date of retrospective restatement. Sir, why taking 1/4/2020? That is your choice. That is your choice. Okay. Or second option is I will have the option to treat the date of transition itself as my deemed date of acquisition. As my deemed date of acquisition. Are we okay with this?
Yes.
Yes. If I take the date of transition as the deemed date of acquisition, what is going to happen? You do not have to go back in time and change everything. Effective date of transition only, you will start preparing your consolidation. Are we okay with this?
Yes. Yes.
Yes. Now, when I need to do a retrospective restatement, okay, why have I given this option that you can pick a date and do a retrospective restatement? Why are you given that option? It should be like in the case of property, plant, and equipment, restate everything retrospectively. Restate everything retrospectively in the case of PP, or basis and exemption, what can you do? I will take previous gap value and will not do a restatement. Take it as a deemed cost and continue. There is no third option that is available to you. Either go back in time, capitalize everything again after analysis, do the depreciation and come to the value, or previous gap value itself will be regarded as your deemed cost. Are we okay with this? This was the position for fixed assets. For business combination, this is not so simple. This is not so simple. Okay. Why? Because business combination is very different from asset accounting. Business combination is very different from asset accounting. Business combination is strategic in nature. Business combination is strategic in nature. Fixed assets accounting is operational in nature. Okay, fixed asset accounting is operational in nature, and therefore, for fixed assets, PPE movement into Ind AS, the options are very restricted. Restate everything or restate nothing and take previous cap value. Matter ends there. In business combination, you have the option to go to retrospective restatement from the date of acquisition, or you select any date in between. That will be your date of what you can say, that will be your date of applying business combination. Or third option, whatever be your date of transition, we assume that to be the deemed date of acquisition. Why do I do this? Because this is regarded as a strategic item. It's not a regular operational item. It's not a regular operational item. Now, what will happen if I take a retrospective restatement date of 1/4/2020? What will happen? What will happen is that if there is any acquisition prior to 1/4/2020, any acquisition, right? If there is any acquisition prior to 1st April 2020, you can ignore those acquisitions. You can ignore those acquisitions. There is no need for you to do a restatement of those acquisitions. Are we okay with this? Yes.
Yes. Yes.
Why would you not want to do an acquisition account? Suppose I purchased one subsidiary on 1/4/2017. If I select the applicability as 1/4/2020, Why would I go back? Why would I take 1/4/2020 when in fact I have purchased another subsidiary on 1/4/2017? I want to show everything. Why am I doing this? Why am I selecting 1/4/2020? It is possible that the subsidiary that I have purchased is a useless subsidiary. I do not want to show the effect of that subsidiary in my Ind AS financial statements. What did I tell in the last class? Ind AS is an option. It is an opportunity to wipe the slate clean. Yes or no?
Yes.
तो ये जो acquisition मैंने किया, the acquisition that I did on 1st April 2017 has not yielded good results. And therefore, as a preparer of consolidated financial statements, I can say that I will not go ahead and acquire this subsidiary and show its consolidation into Ind AS until 1/4/2020. तो सर ऐसा क्या हुआ 1/4/2020 में that you are considering that? Well, you may have a strategic win that took place somewhere in the late March 2019, and therefore 1st April 2020 is officially regarded as the date when you got a very good investment, when you made a very good investment, and today that investment is performing handsomely. So therefore, you would take 1/4/2020 as the date of restatement, and any acquisition prior to that, there is no need for restatement. There is no need for restatement. Are we okay?
Yes.
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 Restatement make everything will change. Your assets taken over will change, liabilities will change, purchase consideration will start including contingent consideration. Okay. Basically, all what you did in 103, everything will come. Okay. You will have the complete net assets coming in. Along with that, you will also have non-controlling interest and you will have goodwill or capital reserve. Are we okay with this? Yes.
Yes.
Are we
Yes.
okay with this?
Yes.
Any
Yes.
doubts?
No, no, clear.
Oh, fine, fine. Okay, so it's a lengthy task. It's a lengthy task. Okay, and therefore you will have to treat it in a manner that suits your requirements. In a manner that suits your requirements. Okay. Now, under accounting standards, we had minority interest. Do you remember?
Yes.
Yes. Now, minority interest, could it be negative under AS?
No.
No or yes? Answer is no. Under AS, it would not be made zero. It would be restricted to whatever contribution it has made. Beyond that, the losses would get accumulated in the parent itself. Are you okay with this?
Yes.
But under Ind AS, can NCI be negative? NCI, non-controlling interest, can it be negative?
I think no.
It can be. It can be negative. Why? Because under AS, minority interest was a liability, whereas under Ind AS, non-controlling interest is a part of equity, and therefore it can become uh, what you say. It can become negative. Are you okay with this?
Okay. Okay. Yes.
Yes. You do you recollect? You would have done this under Ind AS 103. There is a question in your study module also, or I think RTP. Yes. Are we okay with this?
Yes.
So therefore, when you are doing a transition accounting, you will have to view those subsidiaries which you initially choose to do a restatement and do those only. Okay. and after that date, whatever subsidiary you have accounted, there is no exemption that is available. There is no exemption that is available. Okay? You
Yes.
have to do a full restatement. Okay, fine. So now with this background, let us come to your questions. Okay. Okay, go through question number 14. I'll come in a minute. Just give me a. Could you go through the question?
Yes.
A Limited acquired B in a business combination transaction. A agreed to pay certain contingent consideration classified as a liability to B. As part of its investments in its separate financial statements, A did not recognize the said contingent consideration. This was not needed also under AS. Okay. A Limited considered the previous gap carrying amount as its deemed cost on first time adoption. In that case, does the carrying amount need to be adjusted for this transaction? Yes. So, first of all, in the standalone financial statements, what has it chosen? A considered the previous gap value as its deemed cost on first time adoption. Are we okay with this?
Yes.
Yes. So as far as SFS is concerned, no restatement needed. But as far as CFS is concerned, but as far as uh, okay, so I'm sorry, not CFS. If there is any adjustment that is required to the contingent consideration, where will I take it? Contingent consideration. Is this in the nature of a liability? Yes. So you will take it to P&L. You will do an FVTPL accounting. Are we okay with this? Yes.
Yes. Yes.
Because you are given an option to take the previous cap values for investment in subsidiary associates and joint ventures. Okay, so that takes care of this particular illustration. Any doubts so far?
So if it would be contingent consideration in the capacity of employees, then it won't be taken. I think.
In the capacity of employees also it will come, if at all you feel that it is having any implication now. Okay. What do you mean by in terms of employees, Sanjay?
So there were employees whom this consideration, the shares would be allotted.
Okay, you're talking for to those employees for whom we have given shares pursuant to an ESOP scheme, and now there
Yes,
is a CFS which is happening.
yes, yes, yes.
That would be covered under CFS. Okay, so this
Okay,
we just saw it from a limited perspective of SFS. Okay,
okay, okay, okay,
under the CFS, if you will have to do a retrospective restatement, those also will end up getting considered. Okay,
okay.
yes. So 1 second. Okay, illustration 4. Ind AS requires allocation of losses to NCI. Do you agree? Yes. Which may ultimately lead to a debit balance in NCI. Obviously, even if there is no contract to contribute assets to the company to fund the losses. Obviously. Why? Because NCI would have made investment in equity shares, and because they have made an investment in equity shares, their liability would be restricted to the face value of those, to the value of those equity shares. If they have paid the full value, they do not have any obligation to pay anything further. So even if there is no contract, Ind AS says that you go on debiting the loss share to them. Even if it becomes negative, it is fine. Whether this adjustment of losses, should it be done retrospectively? Should it be done retrospectively, or can I do it prospectively? So answer is very simple. If you elect to do a past restatement, if you elect to do a past restatement of business combinations done, then NCI also will be restated accordingly. Yes or no?
Yes,
Yes. But if I say that I take the date of transition as the deemed date of acquisition, then at that point there is no need to you to go back in time and restate the NCI. Are we okay with this?
yes, yes.
Are we okay? So that is a pretty straightforward answer. Okay, nothing new, nothing different. Okay, so that takes care of illustration 4. Okay, next. Okay. A Limited had made certain investments in B Limited's debt instruments. So here I am having A Limited made certain investments in B Limited, convertible debt instruments. These conversion rights are substantive and would provide A Limited with control over B Limited. A has evaluated that B would be treated as its subsidiary under Ind AS and hence would require consolidation in its Ind AS consolidated financial statements. Are we okay with this?
Yes,
B Limited was not considered as a subsidiary, associate, or a joint venture under the previous cap. How should B Limited be consolidated on transition, assuming that A Limited has opted to avail exemption from retrospective restatement of business combinations? Okay. So if I assume that it has availed the exemption from retrospective restatement of past business combination, how will it happen? How will it happen? Okay. All right. Tell me. What is the exemption that it has availed?
from retrospective
That
restatement.
means it is considering date of transition as deemed date of acquisition.
Yes, yes, yes,
Therefore, date of transition is equal to deemed date of acquisition. Yes or no?
Yes.
And therefore, if this is the case, any restatement is needed? Answer is no. There is no restatement that is required. Correct?
Yes. Yes.
Okay. So that is the first part. Because they have availed an exemption, that means they have treated date of transition as the deemed date of acquisition, and therefore no restatement is needed. No restatement is needed. Okay. Let us move one step further. If they had not availed this choice, if they had not availed this choice, would you have to do a retrospective restatement?
Yes.
Yes. And when you do a retrospective restatement, you will not only consolidate, but you will do a fair valuation. You will revise the goodwill, NCI, profit share, etc. from the date of acquisition till now. Yes or no?
Yes. Yes.
So that is one activity that you would be performing additionally. Are we okay with this?
Yes.
Yes, sure.
Sure. Sure.
Okay. So illustration 5 is done. Read illustration 6.
Yeah. Read.
Okay. What is it saying? A has a subsidiary B. On first time adoption of Ind AS by B, it availed the optional exemption of not restating past combinations. What does it mean? Date of transition is equal to deemed date of acquisition. Yes.
Yes.
However, 1 minute. Who? First time adoption of Ind AS by B Limited. Okay. So, see, B is converging to Ind AS. And when B is converging to Ind AS, B would have subsidiaries, let us say B, C, D, and E. Okay. So when B is consolidating, it availed the exemption of DOT equals deemed DOL. Are we okay with this?
Yes.
Do you
Yes.
understand the question?
Yes.
However, A Limited in its consolidated financial statements has decided to go for restatement. Restate past business combinations. Restate past business combination. Yes.
Yes.
Now, whether the amounts recorded by subsidiary needs to be adjusted while preparing consolidated financial statements of A, considering that A does not avail the business combination exemption. We'll see the next part later. See, B has availed the exemption. That means, see, how will I do consolidation in A? कैसे करोगे आप कंसोलिडेट? सबसे पहले आप बी को कंसोलिडेट करोगे ना. यू विल हैव सी फोल्डिंग इनटू बी, डी फोल्डिंग इनटू बी, ई फोल्डिंग इनटू बी, and that will give you consolidated balance sheet of B, and that consolidated balance sheet of B will fold into A. Yes or no?
Yes.
Now
Yes.
that consolidated balance sheet of B, is it a retrospectively restated balance sheet, or is it a balance sheet that is enjoying the exemption provided under Ind AS 101?
It availed the exemption.
It is availing the exemption. That means there is no restatement that has happened from the past. But when B is folding into A, which includes all subsidiaries C, D, and E, A says, I want to restate everything from the past. I want to restate everything from the past. So A के books में there is only one investment, which is B Limited. Yes or no?
Yes.
So
Yes.
A will restate B. Should B restate C, D, and E? What do you think?
I think it should.
It should. Because when parent has given a policy, subsidiary has to follow that policy. Subsidiary cannot say, I will not do it. Okay. So because of this, B also will end up restating its numbers, but that restatement is only for the purposes of consolidation with A. For consolidation with A. Are we okay with this?
Yes.
So
Yes.
when B does its corporate filings for B Limited, will it do a retrospective restatement? Answer is no. But when A does its corporate filings, the B's consolidated financials will have a retrospective restatement of C, D, and E. Are we okay with this?
Yes. Yes.
Whether amounts recorded need to be adjusted? Answer is yes. It needs to be adjusted. Okay. Now, now, what is the next part? Will the answer be different if A Limited adopts Ind AS after B Limited? Okay. If A Limited adopts Ind AS after B Limited. Tell me one thing. If Ind AS applies to B, will it apply to A?
Yes.
Yes? Yes or no?
Yes.
Obviously, it will. If Ind AS applies to one of the group companies, all the companies forming part of that group, Ind AS will become applicable. So, the moment B has Ind AS, it means A also will be having Ind AS. It means A also will be having Ind AS. Yes or no?
Yes.
But now they are saying, will the answer be different if A adopts Ind AS after B Limited? That means what? Situation क्या है समझो, understand. Okay, I have A Limited, I have B Limited. B Limited के लिए Ind AS is applicable. Then you have C, D and E. Here also Ind AS is applicable. Here also Ind AS is naturally applicable. Now they are saying that in a situation where Ind AS applies to B first and then it applies to A. This cannot happen when both of them are holding, I mean, when A holds shares in B right from the beginning. It cannot happen. This situation where Ind AS applies to B and AS applies to A, this is possible only and only when first B Limited has moved to Ind AS, first B Limited has moved to Ind AS, and after that A Limited acquires control over B. Acquires control over B. Are you okay with this?
Yes.
Yes. Are you
Yes.
okay?
Yes. Yes.
A can be under Ind AS. B can be under Ind AS. But then A says, I will acquire B. Can it do that? Answer is yes. Buying a business has nothing to do with which framework you are following. So therefore, in this particular case arises only when A obtains control over B after B has transitioned to Ind AS. Okay, so this scenario arises only when A acquires control over B after B transition to Ind AS. Are we okay with this? Yes.
Yes. Yes.
Yes, after B transition to Ind AS. Okay. Now, let us suppose B transition to Ind AS in 2016-17. For A, it will be applicable in 2020-22. Okay, right?
Yes, sir.
Now see, think about it. Logically सोच रहा हूं, it's quite simple. Common sense लगाओगे आ जाएगा. B has opted for a policy not to restate. कब से? 2016-17 से. B has opted not to restate. उस time पे A was not even in the picture. So B prepared its consolidation, etc. for 3, 4, 5, 6 continuous years based on the fact pattern that we have chosen not to do a retrospective adjustment. अचानक बीच रास्ते में A आ गया और B को एक्वायर कर लिया. Suddenly A came from nowhere, purchased B. Yes. Now because A has purchased B, Ind AS applies. Yes, 2022 onwards. And because Ind AS applies 2022 onwards, A has come to a position that whatever happens, I will not avail the exemption. I will go for a complete restatement. Did you follow?
Yes.
Now, will it be correct to expect B to do a restatement of all its prior business combinations? Yes. See, B had its independent existence. Bolo yaar.
Yes.
B had its independent existence in 1617. B had CDE. It availed retrospective restatement exemption. Yes or no?
Yes.
It availed the retrospective restatement exemption. Can I say that it continued with the same in 1718,
Yes.
1819, 1920, 2021, 21-22? Till 2021, it availed that benefit. Suddenly in 21-22, A Limited came in place and became the parent of B. Okay. And A Limited says no retrospective exemption. No retrospective exemption. Are you okay with the conditions?
Yes, understood.
Okay. Now tell me, if A has availed a no retrospective exemption wala benefit, I mean, it has forfeited that benefit, it will do a retrospective restatement for B Limited. Okay. But should B restate C, D, and E?
Not necessary.
Not required. Q, sir, when B availed the exemption, A was not even in the picture. After 3-4 years, A has acquired B. You cannot expect B to do a modification just because some other company acquired it after 4-5 years. Are you able to follow?
Yes.
Yes?
Yes.
Sure? No doubts.
Sure, sure.
Okay. So therefore, this particular exemption is a very unique piece of exemption that is there. This particular exemption is applicable only when a parent company transitions to AS after B and has acquired control over B over a subsidiary after the subsidiary has transitioned to Ind AS. Are we okay with this?
Yes, yes, got it.
Yes,
Yeah.
sure. Samjha, are you finding it interesting?
Yes, yes,
Yes. Are
absolutely,
you
yes.
able to connect the dots?
Yes, yes.
Yes. Okay, fine. So that takes care of illustration 6. Okay. Go through question 1. Go to question 1. Read it.
Yes, go on.
Okay. What have you understood in the question? Think. You can remain unmuted only. What have you understood?
Yeah, it will adopt to restate the restatement of financial statements retrospectively.
It has opted to restate its past business combination. Okay?
Yes,
Okay. Now, if I do a retrospective restatement, what should I do? Retrospective restatement का मतलब क्या हुआ?
restate the previous financial statements.
हाँ,
Uh,
मतलब business combination के लिए, for
business.
business combination. Okay, that means what? You will go back in time. आप time travel करोगे. आप टाइम में जाओगे, पुराने टाइम में. उस डेट पे फिक्स्ड एसेट्स, लायबिलिटीज, एसेट्स, all items you will do a fair valuation. You will do the contingent consideration and all. उसका valuation अगर है तो उसका valuation बनाओगे. All of that, after it is done, you will compare with the purchase consideration, and that will give rise to your goodwill. Are you able to understand?
Yes, yes,
Yes. And you will then take subsequent periods P&L, and you will do the adjustments and come to the current year. Are you okay with this?
yes.
Okay. Now tell me, have I taken the same values or have I restated the values?
Restated.
I have restated the values. Okay. Now, क्या पूछ रहा है? If business combinations are restated, whether certain other exemptions, such as deemed cost exemption for PPE, can be adopted. Now, see, I have to prepare my financials. Yes,
Yes, yes,
because I have to prepare my financials, I have to take property, plant, equipment also into my financials
yes,
post the transition. Yes,
yes,
that particular item of property, plant, equipment, do I have a previous gap exemption?
yes,
Yes.
yes,
Previous gap exemption मतलब जो पुराने सिस्टम में आपके वैल्यूज थे, the same will be the values in the current period. Yes or no?
yes,
Now, again there is a conflict. You are restating business combinations, because of which you are restating the values to fair value. Number one. But number two, it wants to avail the transition benefit available in respect of property, plant, and equipment. Is it possible? Did you follow?
yes, I follow.
Yes. Can it do that?
I don't think so.
It cannot do that because The restatement option which you are doing is pursuant to business combinations. Yes?
Yes, yes.
And that is a strategic item. So you cannot say, I will avail deemed cost. So therefore, I will take those values of assets for the purposes of restatement. आप ऐसा कतई नहीं कर सकते. You cannot do that. But suppose there are other property, plant, equipment items apart from the business combination items. Do you understand?
Yes,
Yes.
yes.
That means I have certain items which do not belong to the subsidiary. They do not belong to business combination of, items, but they belong, say, to the parent whom we are converging. Yes, वो पहले भी थे, वो अब भी है. Yes or no?
Yes, yes.
And therefore, can I follow deemed cost exemption for those items of property, plant, and equipment?
No.
No, for that you can do. For that it is allowed. Why? Because that is not an aspect of business combination.
Okay,
That is
yes.
not an item of business combination. Did you understand?
Yes, yes, yes. I got it. Yes,
Yes.
yes.
Want me to write and explain? So I have, suppose, A and I have B. Now, what has happened is restate past business combinations. And because of this, what will be the fallout? Fair value accounting of property, plant, equipment. Fair value accounting of property, plant, equipment. Liabilities. Purchase consideration. Goodwill. Are you able to follow?
Yes,
Yes.
yes.
But A is having certain own PPE. Can it avail deemed cost exemption? Can it avail deemed cost exemption?
Yes,
Answer is yes. As it is not part of business combinations. Sorry. Yes or no?
yes.
Understood? Sure.
Yes, sure.
Okay. So that takes care of question one. That takes care of question one. Okay. Now, अब और क्या है? He did illustration 14. Yes. He did illustration 14 also. Okay. Okay. Okay, so those items were about business combinations. We then move on to compound financial instruments. Okay, compound financial instruments. So far, what are the special items that we have covered? First one was
Loans,
नहीं
long
नहीं.
term
So far, what we have covered. अभी तक हमने स्पेशल आइटम्स में क्या पढ़ा है? सबसे पहले ESOP.
ESOPs, yes.
Then second one was foreign exchange.
Foreign exchanges.
Third was property, plant, equipment. Fourth was business combinations. Now fifth is compound financial instruments. Yes.
Yes, yes.
So now fifth is compound financial instruments. Now, example, convertible debentures. Convertible debentures. Now, what do you mean by convertible debentures?
Will be converted to equity shares.
It will be converted into equity shares. Let us suppose these are optionally convertible. Okay. Now, how would you show this under old standards? Under accounting
Share
standards,
equity share capital.
nahi, this
Share
would be part of loan under accounting standards. Yes or no?
yes, yes.
But under Ind AS, what will you show?
Here we will show it as part of equity.
Equity plus debt. It is a optionally convertible debenture. So therefore, it will be shown as some portion going to equity, some portion going to debt. Yes or no?
Yes.
You
Being
remember
compound fund.
split accounting that you would have done under
Yes.
financial instruments? The same thing. Okay.
Yeah.
Now, how will I do this transition? How will I do this transition? First of all, will there be any exemption to this? Will there be any exemption to this? Answer is no, because you cannot alter the fundamental characteristic of the instrument. You cannot alter that. Okay, so that will be consumed. Okay, now under Ind AS, I will have to take the equity and the debt component. Okay, so on the date of transition, you will have to present the equity and the debt component. You will have to present the equity and the debt component. Okay, so let us take an example. Face value 1 lakh. %7. Market rate of non-convertible bond 10%. Optionally convertible with tenure of 5 years at option of the holder. At option of the holder. Previous gap and Ind AS. Previous gap, you would have passed the entry bank account debit to convertible debentures. Do you agree with this? Yes.
Yes.
Date of transition 2 years after bond issue. Are you okay? Yes.
Yes.
Now, under Ind AS, how would you account for this? Yes. 7% is coupon, 10% is market rate. 5 years is the tenure of the bond. So therefore, it will be fair value of liability is equal to 1 lakh into 7% into 1 lakh into 7% into 3.7908. This is your yearly outflow towards interest, correct? And it is happening over a period of 5 years. PVAF 10% 5 years plus at the maturity you will get the value back. So this gives you are you able to follow? Yes.
Yes, sir.
This is how you do the conversion.
Yes.
One minute. Here it is. Yes. 88,626. My bad. Are you okay?
Yes, 88,626. Yes.
So on date of issue, the entry that should be passed is bank account debit 1 lakh to equity component to liability component. 88,626 is your liability. 11,374 is your equity. Are you okay with this? Yes.
Yes, sir.
Now, can I take this value as the value of my compound financial instrument on the date of transition?
Yes.
नो, डेट ऑफ ट्रांजिशन देखो क्या है, 2 years आफ्टर बॉन्ड इश्यू, है ना. दिस इज द कन्वर्जन फैक्टर ऑन द डेट ऑफ इश्यू. यस और नो.
Yes. Yes.
समझे. तो
Yes.
आपको 2 साल का अमोर्टाइजेशन करना पड़ेगा. यू विल हैव टू डू 2 times अमोर्टाइजेशन 2 years के लिए. यस.
Yes.
सो देयर फोर amortization table. You recollect doing this in financial instruments?
Yes. Yes.
Year opening balance,
Unwinding of
EIR,
unwinding of interest.
unwinding of interest, EIR at 10%, coupon rate, closing. Year 1, opening 88,626, 8,863. Coupon is 7,000. 90,489. 2. $92, 538. Okay. Your equity component remains the same at 11,374. Yes or no?
Yes. Yes.
But your liability component goes to 92,538. Yes?
Yes. Yes.
All right. Now, what will be the value on transition? This will be the value and this will be the value. Yes or no?
Yes. Yes.
So on date of transition, this will be your entry. Which one? First of all, convertible debentures, which is appearing at 10,000, will go away. Convertible debentures account debit. 2, liability component 92,538. 2, equity component 11,374. Yes or no?
Yes.
$3,912. Where will this go?
Retained earnings.
Yes. Retained earnings. Yes or no?
Yes.
Any doubt so far?
No. Clear. Clear.
Why am I getting a difference of 3,912?
We have taken for 2 years only
हाँ,
unwinding
तो मेरा
interest.
जर्नल एंट्री में गैप आ रहा है ना 3,912. Yes.
Yes.
Why is that happening? Let me show you. Why? I hope you are noting this down.
Yes. Yes. Noting.
Okay. Ind AS. Interest. Year 1. 88, 63, 9049. First year 7,000. Second year also 7,000. 17,903, 14,000. Did you see this?
Yes.
Yes. It's equal because of rounding off, this gap is there. Yes.
Yes.
So what's basically this 3912? This is additional interest cost in Ind AS. Yes or no?
Yes.
This is the additional interest cost that is coming in Ind AS, which is the reason why, as you mentioned, take this to retained earnings. Otherwise, it would have gone to the P&L. Yes or no?
Yes. Yes.
But here I can't take it to the P&L. So therefore, I take it to the retained earnings. I take it to the retained earnings. Any doubts?
No, clear.
All clear? Fully
Yes.
clear?
Fully.
Satisfied? Yes.
Yes.
All right. Fine. Wait a minute. And, illustration 15. Okay. Illustration 15. On April 1, 20X1, Sigma issued 30,000 6% convertible debentures of face value 100 per debenture at par. Debentures redeemable at a premium of 10% on 31st March 20X5. Or these may be converted into ordinary shares at the option of the holder. Interest rate for equivalent debentures without conversion rights would have been 10%. Date of transition is 1st April 20X3. Suggest how should Sigma account for this compound financial instruments on the date of transition. The present value of rupee 1 at 6% and 10% can be taken as below. Are you okay with this?
Yes.
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 Can you do it right now? Can you try
Yes.
to solve?
Right. Yes.
Yes. Read the question, try to solve. I am here only. Okay. Let us
Okay.
see. If you are stuck somewhere, I will pitch it. But it is the same question what we have done. There is only one small change that I will see how you are doing it. Otherwise, largely it is exactly what we have been doing. Okay. Let's do that. I'll come in a minute. Yes. Where are you? This is illustration 15. Now,
This fair value comes to 26 lakh 10,600.
let us check. Issue proceeds 30 lakhs. Now, there are two components to this, liability component and equity component, right? So now when I look at the liability component, there is a coupon of 6% over a period of 4 years, right?
4 years, yes.
So 30 lakhs into 6% into 3.17, correct?
Correct, yes.
This is present value annuity factor of 10% for 4 years, correct? Plus principal will get redeemed. It won't be 30 lakhs. They have said it is redeemed at a premium of 10%, correct? These debentures are redeemable at a premium of 10%. So did you take 30 or 33 lakhs?
30.
30. So that is the issue. Okay. Plus 33 lakhs into 0.68. Present value factor 10%, fourth year. Yes. So
Yes.
that gives you the value. Five lakh 70,600 plus 33 lakhs 22 lakh 44,000. So 28
14,600.
600. 1 lakh 85 400 is your equity component. Are we okay with this?
Yes. Yes.
All right. So this is your value on 1st April 20x1. On 1st April 20x1. Okay. Date of transition is 1st April 20x3. That means after 2 years. So can I take these values on date of transition? Answer is no.
No.
I will have to do an amortization table for how many years?
2 years.
2 years. So calculation of liability and equity component on 1420x3 year 1 2 opening 28 14 600 EIR at 10% 2 lakh 81 460 coupon 1 lakh 80,000. There is no principal repayment on a yearly basis. So we will be doing the only coupon adjustments. 2916 060. $30,27,666. Are you okay with this?
Yes.
Yes. All right. Now, under Ind AS, how would you have, sorry, under AS, how would I have accounted? Okay. Treatment under AS. How would you do? 1420x1. Bank account debit
Bank to convertible debentures.
to convertible debentures. 30 lakhs. Correct?
Yes.
30 will be redeemed at 33. Yes or no?
Yes.
So when 30 will be redeemed at 33, under AS, would I record interest in fourth year or would I spread the interest over 4 years?
Spread.
You would spread. That means हर साल आप कितना interest account करोगे? 3 lakhs divided by 4, 75,000. Correct?
Correct.
So therefore, 31,320x2 and 31,320x3. Both these years you will pass same entry. Interest expense debit to convertible debentures. 75,000 each year. Huh? So 75,000 for first year, 75,000 for second year. Are you okay with this?
Yes.
Yes. All right. Fine. So now Ind AS. AS. Liability component, debt component. Sorry, not debt, equity component. What is my equity component? 1,85,400.
100.
Correct?
Yes.
In AS, it will not be there. Okay. What is your liability component here? 30,27,666. Agreed?
Yes, agreed.
And here it would be 31,50,000. How 31 lakh 50? 30 lakh plus 75,000 plus 75,000. Yes or no?
Yes. Yes.
So therefore, entry on date of transition. Convertible debentures account debit 31,50,000 to liability component of compound financial instrument 30,27,666 to equity component of compound financial instrument 185,400. $63,066. Retained earnings. Are you okay?
Yes.
Any doubts? No doubts?
Clear.
What is the 63066? Can we do a reconciliation?
Yes.
Check. Ind AS. Interest year 1.
$281,460.
Yeah. Year 2. 281,460. 291,606. What will be your interest under AS? Coupon 1,80,000
1,80,000.
plus principal 75,000. आप वो प्रीमियम अमोर्टाइज कर रहे हो ना, so 75,000. So 1,80,000 plus 75, 2,55,000 each. Is it okay? Yes.
Yes.
281,460. So this is difference 63,066. Any doubts so far?
No. Clear.
Clear?
Clear.
Nice question.
Yes.
Yes. Okay. So that takes care of illustration 15. No doubts. Okay. Fine. Shall we move on to the next one then?
Yes.
So we have done under special cases, ESOP, foreign exchange, property, plant, equipment, business combinations, compound financial instruments, right? Next, we move on to investment in joint ventures. Acha. Do you remember how we would account for joint venture under accounting standard 27? Yes. Okay. Forget that. In Ind AS, how do you account for joint ventures when you prepare consolidated financials? You follow something known as equity method of accounting. Yes or no?
Yes. Yes.
What is equity method? My investment in associates will be there, and the investment in joint ventures will be there. To that, whatever is the profit for the current year, I will add that. That will become my closing. If there is any distribution of dividend, etc., I will reduce it from that. So that becomes my equity method of accounting. Is it okay?
Yes.
Yes. You
Yes.
remember doing this?
Yes. Yes.
Okay. Now under AS, in AS 27 to be specific, joint ventures were accounted for using proportionate consolidation method. Using proportionate consolidation method. That means if I'm owning 50% in a joint venture, I will do a line by line consolidation of 50% of the joint venture's assets and liabilities. Is it okay?
Yes.
Yes. And
Yes.
in P&L also, I would do a 50% accounting of income and expenses. Okay. Now the issue is When I'm transitioning from AS 27 to Ind AS 28, I think, equity method of accounting, investment in associates and joint ventures, I think it is Ind AS 28 or Ind AS 111 also, I think. Okay. Anyways, so under that scenario, we do not consolidate line by line under Ind AS, whereas under AS, we do a proportionate consolidation. Yes. So what do I have to do when I transition? What do I have to do when I transition? Bolo, by now you should be getting a hang of it, right?
Restate.
Restate matlab what has happened in AS, you will have to nullify that. And what should happen in Ind AS, you should bring that. Because bases are totally different. In AS, I would add everything to the balance sheet line by line. Whereas in Ind AS, I should not be doing that at all. So therefore, whatever was done in AS, you will have to remove. And what needs to be done in Ind AS will be considered as applicable. Are we okay with this?
Yes, yes,
Yes. The
yes,
other side is under AS, because you would have paid something for acquiring interest in a joint venture, which we call it as a purchase consideration. Against that purchase consideration, you would be recording your assets and liabilities, yes or no? So
yes,
therefore, is there a chance of goodwill arising under AS? Answer is yes, because you have a purchase and then you have accounting. You have a proportionate consolidation. So you have proportionate net assets getting accounted under AS, against which there is a purchase consideration. These two will not match. The difference will give rise to goodwill. Yes or no?
yes.
That will not happen under equity method of accounting. That will not happen under equity method of accounting. So क्यों नहीं होगा equity method of accounting? Where are you consolidating assets and liabilities? है ना? Yes or no?
Yes, yes.
So therefore, there won't be any goodwill that arises in equity method of accounting in the financial statements rupee column. There won't be any. In the amount column, you will not have a goodwill appearing separately. Are we okay with this?
Yes, yes.
In a disclosure, it will come. I don't deny that. You will have a disclosure that comes when you do associates and all. You will have a disclosure of goodwill, but it will not form per se a part of your reported figures in the financials. Okay. So now, basis that understanding, what will happen is in joint ventures, जो भी consolidate हुआ है line by line, we will have to remove that. We will have to eliminate the goodwill. And then whatever is the impact of these entries, that will obviously go where? Where will that go?
Retained earnings.
Will that go in retained earnings or will that go in investment?
Investment.
It will go in investment. It cannot go in retained earnings because this will affect my investment cost. Okay, this would be affecting my cost of investment. So therefore, it will go there. Okay, or rather carrying amount of the investment. Okay, so that is something which we are having in terms of joint ventures. Okay, so we take a break. After the break, we will do some questions. Then we are left with two, three small issues. I think we can deal with it. Tomorrow there is a class. I hope you have seen the schedule, right?
Yes.
So I think we will go through some questions and then tomorrow some small two, three topics will be left. We can wind it up tomorrow. Okay. So for now, we take a 15-minute break and we shall resume after 15 minutes. Okay. Break, please. Yes. So that was about investment in joint ventures. Basically, we remove what was happening under AS from the balance sheet, and we take the differential in the cost of investment. Always remember, we need to remove the goodwill as well. Okay. So basis that, let us come to a question. It is a slightly different question that you will see. Okay, something that is done a little uniquely, but that is the best that could be done with the information available. Yes. Okay, illustration. Question 1, 2, 3, 4, 5, 6. Following accounting standards notified under Companies AS Rules 2006. The company has decided to voluntarily adopt Ind AS with effect from 1st April 20x2 with a transition date of 20x1 1st April. The company has one wholly owned subsidiary and one joint venture which are into manufacturing of automobile spare parts. The CFS of the company under Indian GAAP, that is under AS, are as under: share capital, reserves, long-term borrowings, provisions, liabilities, trade payable, short-term provisions, PPE, goodwill on consolidation of subsidiary and joint venture, both. Investment property, long-term loans and advances. Current assets, you have trade receivables, investments, and other current assets. The company has shares of ABC Private Limited. Okay. Presently, the same has been accounted as per the proportionate consolidated method. The proportionate share of assets and liabilities of ABC Private Limited included in the CFS of XYZ is as under. So all these items are debit, current assets, trade receivables would be debit, current assets debit, trade payables credit, short-term provisions credit. The investment is in the nature of joint venture as per Ind AS 111. Suggest the accounting adjustments which are required to be made in the opening balance sheet as on 1st April 20x1. Okay. So first of all, you need to eliminate all of these, right? आपको ये सब eliminate करना पड़ेगा. You will have to eliminate. So basically the journal entry will be like, I will credit property, plant, equipment. I will credit long-term loans and advances. I will credit trade receivables, other current assets. I will debit trade payables and short-term provisions. Are we okay with this? Yes?
Yes, yes.
The issue arises now with goodwill. Goodwill is 1507, correct? Is this goodwill for the subsidiary or is it for the joint venture?
And this is for the both.
It is for both. It is for both. And because it is for both, I should split it. Yes?
Yes.
Now, ideally, the question should have given what is the goodwill on acquisition of the joint venture, and what is the on acquisition of the joint arrangement, and what is the goodwill on acquisition of the subsidiary. That is not given in this question. Okay. So because that data is not given, we will have to do some calculation. Okay. That is a very ballpark figure that we are getting. Okay. But in the absence of data, I think that is the best answer that is possible. Okay. So with that, let us look at how to do the split for goodwill. Okay. That is the only critical part that is there. Otherwise, it's all okay. All right. So this is question 5. Goodwill on joint venture. Actually, you should have received, but because they have not given in the data, then we will have to do a proportionate working. Okay. Now see. The goodwill on joint venture arises because I have acquired these items, correct? Yes or no?
Yes, yes,
And because I have acquired these items, I would have paid something for that. And that something which I have paid is more than the net assets which I have acquired. That is why you have your goodwill, correct?
correct.
Similarly, for the subsidiary also, you would have acquired net assets.
Yes,
So therefore, what this question assumes is these items of net assets are acquired by the joint venture, which has given rise to goodwill, correct?
correct.
Similarly, same items are also giving rise to goodwill in the subsidiary. Is it okay?
Yes,
That means 1507 worth of goodwill is arising because I have prepaid something more for these net assets. Okay, I have prepaid something more for these net assets. Only these net assets. For the other net assets, whatever is not there. For example, see, do I have investment property in this? In the second table, do I have investment property?
no,
No. But here I have investment property, right?
yes,
Yes. So what probably is the assumption that is made here is when the subsidiary also was acquired, all other items which are not in the second table, they are acquired at the value which was fair. Whereas for these items, we have paid something extra. Okay. This is the assumption that has gone behind in the solution. Are we okay with this?
yes, sir.
Yes. For assumption, you can assume anything. Okay, so they have done this assumption, which to some extent it is, I will not say it is not completely wrong also. Okay. Now the issue is, how do I show this? How do I do the split? So can I say that 1507 is for total net assets mentioned in second table?
Yes,
Out of that, this value pertains to joint venture.
yes,
So can I do proportionately?
yes,
Yes. So now let us start doing that. Okay. So goodwill on joint venture is equal to goodwill of subsidiary plus joint venture multiplied by multiplied by, we'll see first one, corresponding net assets of the group, which is the total parent plus, subsidiary plus joint venture. And here, this includes goodwill itself. And here, proportionate net assets of joint venture. Are you able to follow? Yes or no?
yes, sir.
So this is equal to 1507 multiplied by, what is the net assets? 1200, 405, 280, 50 minus 75 minus 35.
Two 280 plus 50
Yes, 280 plus 50
minus 75
minus
minus
35
35.
divided by corresponding net assets of the group. So for 1200, this is property, plant, equipment. The value is 21,288 plus 405 is long-term loans and advances, 6350. 280 trade receivables, 4801. Other current assets 50, 1554 minus trade payables 9905 minus short-term provisions 500 plus 1507. Is it okay?
Yes, goodwill on consolidation is included.
They have included. Okay. There are some alternative
But
views I will give after we finish the solution as given in the study material. Okay.
we have not taken investment property.
नहीं क्योंकि corresponding ना 1200 is for the joint venture, 21288 is for the group, 405 is for the joint venture, 6350. It is not
Okay.
net assets of the group. I have mentioned as corresponding net assets of
Okay.
the group. Okay.
Okay.
So this comes to how much? 1825 divided by 23,137. So that is 119. Correct? Any doubts till now?
Clear.
Clear? Okay. So now, what will be the journal entry that needs to be passed? First one, to goodwill. My goodwill will reduce by 119. To property, plant, equipment, I will eliminate 1200. To long-term loans and advances, 405. All what is included as a joint venture proportionate consolidation, we are eliminating. To trade receivables, 280. Other current assets, 50. Trade payables, we will have to debit because it is normally a credit.
$75.
75 and 35, yeah. Current provisions, 35. If you do the add list, 1944. This figure will get added to your investment in ABC joint venture. Are we okay with this?
Yes.
Any doubts?
Clear.
Clear? Okay. Fine. Now, a couple of points. Done? You have
Yes, done.
noted down the journal
Yes,
entry?
yeah, done.
Okay,
Yeah, noted down.
fine. Now, first of all, if I have to find out goodwill on a proportionate basis, I cannot include goodwill in the denominator. Yes or no?
Yes,
Ideally, goodwill होना नहीं चाहिए. If you are dividing this 1507 in the ratio of net assets of joint venture and net assets of the group, then net assets of the group again cannot include goodwill. है कि नहीं?
yes,
Yes. So that is one point where you could find uh, certain mismatch or something. Okay. When you do a revision tomorrow, probably you may come across this. Okay. First one, inclusion of goodwill in denominator. Okay. Second, we have assumed that goodwill is arising only in respect of those assets and liabilities which is there in the joint venture. We have taken only those for the group as well. Yes or no?
yes.
Yes.
Corresponding
जैसे
to
हमने
that.
इन्वेस्टमेंट प्रॉपर्टी का नहीं लिया है, राइट?
Yes, right, right.
ओके, सो goodwill assumed to arise out of only those assets and liabilities pertaining to the joint venture. Yes or no? Again, nothing
Yes,
wrong here because मेरे पास data ही नहीं है question में. So if I have to do some sort of allocation, this seems to be the most reasonable available from all the options. Is it okay?
yes, okay.
Yes. Third, look at this balance sheet. Whose balance sheet it is? Whose balance sheet it is?
XYZ Limited,
Okay. Which balance sheet is it? Standalone or consolidated? Is it a standalone or a consolidated balance sheet?
consolidated.
Consolidated. तो consolidated balance sheet में which entities are included?
Subsidiary and joint venture.
Subsidiary joint venture तो है ही है, but parent also will be there ना.
Parent, yes, yes.
So CFS में you cannot avoid the parent ना. Parent plus joint venture plus subsidiary. Yes or no?
Yes,
Now look at your working. 1200 is the property plant equipment of the joint venture. Correct?
correct,
21,288 pertains to the group. Correct?
correct,
Group means parent plus subsidiary plus joint venture. Correct?
correct, yes,
But goodwill cannot arise from parent's own assets. Yes or no?
yes,
That means when we prepare this calculation, the assumption is that parent does not have any property plant equipment of its own. Parent does not have any long-term loans and advances of its own, जो भी है, it is of the associate or the जो भी है, it is of the joint venture or the subsidiary. Parent does not have its own trade receivables. Whatever is there is of the joint venture and the subsidiary. Other current assets, parent has nothing of its own. Trade payables, parent has nothing of its own. Short-term provisions, parent has nothing of its own. Yes or no?
Yes.
This is one assumption that is done. And of course, you have certain items in the balance sheet which is not forming part of this. So those could pertain to the parent. I do not deny that. Okay, but as far as these items are concerned, it is implicitly assumed that parent does not have any of these. These are items solely belonging to the joint venture and the subsidiary. Is it okay?
Yes, okay.
Yes,
But
matlab, see, when data is not there in the question and you have to do a split, you need to make some assumptions. So these are the bedrock on which your workings are standing. Is it okay?
yes, sir.
There is nothing wrong in the two assumptions that we have mentioned just now. Okay.
Okay.
It in light of the information, it is the best assumption that is made. Okay. First assumption क्या था हमारा? Goodwill
Goodwill
assumed to
included.
arise only out of those assets and liabilities pertaining to the joint venture, which is okay. It is justifiable. It is possible also that you only pay extra for those 5-6 line items which are mentioned in the second table. Yes or no?
Yes.
Okay. Next. Third assumption, parent has no items of net assets parent has no item of net assets appearing in the balance sheet shown as there's no item of net assets appearing in the balance sheet which pertain to joint venture and subsidiary above. Which pertain to joint venture and subsidiary above. Other items in the balance sheet could belong to the parent. We are saying it could belong to the parent. Is it okay?
Okay.
Yes. So this is the basis on which this solution is prepared. Is it okay? So 2 and 3 are assumptions. If I view them from the perspective of assumptions, and they look to be not that bad. Number one is a small, what you can say, a small issue. 1507 goodwill possible hoga, so I think we should eliminate that from the denominator. Okay. Otherwise, no issues. Okay. So that takes care of this question. What else they have asked actually? Suggest the accounting adjustment. So we have given the journal entry. Yes or no? So that completes question 5. Any doubts so far?
No, clear. Although this holding company would have plant, property, and equipment in its books, it's highly probable that it has PPE. But
It
we
could
assume that
have, but even then, it is still possible, that some, see what happens. Many times you have the main holding company as only a investment company. It is absolutely possible. जैसे you look at Tata Group. Tata Group में who is the holding company?
Tata Sons.
Tata Sons. आपको क्या लगता है टाटा सन्स इज मैन्युफैक्चरिंग समथिंग?
No, 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 no.
इट इज एन इन्वेस्टमेंट हाउस.
Yes, sir.
इन्वेस्टमेंट हाउस में गिन चुन के होगा क्या? यू विल हैव इन्वेस्टमेंट प्रॉपर्टी और यू मे हैव योर ओन ऑफिस स्पेस or you may operate from a rented premise. So a Tata Sons balance sheet will have share capital and it will have normal cash balances and investments in subsidiaries, associates, joint venture that will be comprising more than 80-90% of its balance sheet. Yes.
Yes, sir.
So from a structure perspective, it is totally doable. I mean, there, as far as the institute's assumptions are there, that is totally incorrect. I cannot say that. Okay, because you do have structures in reality also where the ultimate parent company is an investment company. So this also would probably be such of a similar structure. Is it okay?
Yes, yes, okay.
All right, fine. So that takes care of number 5. So 1, 2, 3, 4, 5. I think 6
6.
also we have done. So all questions from test your knowledge we have completed, right? So that is done. All right. Next. Fine. Let us now come to certain questions. See, for doing 101, the main point is this. You need to know what is the treatment of the item under AS. You need to know what is the treatment of the item under Ind AS. ये दो चीजें जब पता होंगे आपको, then the transition is not a problem. Because that much accounting we are also aware कि transition के time पे अपने को entry क्या pass करनी है. That accounting at this level is not an issue for any of us. हाँ, 101 does give you the benefit of surrogate or proxy values, what we call as exemptions, exceptions, reliefs. That benefit is definitely given in Ind AS 101. That is something that you and I are focusing more on. Yes or
Yes.
no? Otherwise, joint venture, what is the exemption that is given? There is no exemption. You are totally eliminating what is accounted under AS and you are bringing what is to be accounted under Ind AS. That's about it. Yes or no?
Yes.
Okay, fine. So with that background, I think let us come to illustration 16, which is not difficult. Okay, I think you should be able to resolve this. Okay, as we discuss. Okay. H Limited has the following assets and liabilities at 31st March 20X1 prepared in accordance with previous GAAP. So prepared as per previous GAAP. This is non-Ind AS. Okay. Property, plant, equipment, investment in subsidiary, trade receivables, advances for purchase of inventory, inventory cash, giving you total assets of 2 crore 42 lakh 99,000. VAT deferral loan 60 lakhs, creditors 30 lakhs, short-term borrowings 8 lakhs, provision 12 lakhs, total liabilities 1 crore 10, share capital 1.3, reserves 2 lakh 99, cumulative translation difference 1 lakh, ESOP reserve 20,000, retained earnings 1 lakh 79, total equity 1 crore 32.99, and total equity and liabilities 242.99. Is it okay? Yes.
Yes,
The
okay. Yes.
following gap differences were identified by the company on first time adoption of Ind AS with effect from 1st April 20X1. In relation to property, plant and equipment, the following adjustments were identified. PPE comprises of land held for capital appreciation costing 4,50,000 and was classified as investment property under Ind AS 20, under Ind AS 40. Exchange difference of 1 lakh were capitalized to depreciable property, plant and equipment on which accumulated depreciation of 40,000 was recognized. There were no asset retirement obligations. The management intends to adopt deemed cost exemption for using the previous GAAP carrying values as it deemed costs as at the date of transition for PPE and investment property. The company had made an investment. Okay, fine. So adjustment 1, what do we do? What do we do in adjustment 1?
We will classify this investment property as held for sale as per AS 40.
नहीं, not held for sale, classified as investment property. पहले कहा था it was forming part of property, plant and equipment. Now where it should go? It should go under
investment property. Yes.
Investment property.
Yes.
So this is which kind of an adjustment? Is this a remeasurement adjustment or a reclassification adjustment?
A reclassification.
This is a reclassification adjustment. So come to illustration 16. Adjustment entries. First one, land, which is property, plant and equipment worth 4,50,000. Sorry, land which is investment property will come in existence, and investment property which is PPE will go out. Did you follow?
Yes, sir.
Yes. So that is the first adjustment. Next. Exchange differences of 1 lakh were capitalized to depreciable property. Okay. On which accumulated depreciation of 40,000 was recognized. What do we do with this?
We'll debit PPE by 1 lakh.
Read the question and see what they are telling. Exchange difference of 1 lakh capitalized to property, plant, equipment. This is which step? This is second step, second special case that we saw, foreign exchange. Yes or no?
Yes.
Could I capitalize exchange difference into PPE? Yes. If you had availed the option under AS11, you could capitalize it. Yes. And on that, the accumulated depreciation is 40,000 rupees. Yes or no?
Yes.
So now you tell me, is this something outside the purview of transition, or is it something which is very much a part of transition?
Yeah, part of transition.
No, I mean to say, is this something for which an adjustment is needed, or is it something which is acceptable for transition? Just move it as it is.
We will take exchange differences to P&L account.
But you have an option, right? If they followed option 2 under AS11, you can continue to follow option 2 under AS11. Yes or no?
Yes, option is there.
Bas. So we take that option. Capitalized to depreciable property, nothing is given. So can I continue this? Answer is yes. Yes or no?
Yes, yes.
And on that, accumulated depreciation of 40,000 was recognized. No, so ठीक है ना, 1 lakh is capitalized, 40,000 is depreciation. So balance will be the WD. Yes or no?
Yes.
So this is also perfectly fine. You don't have to do any adjustment. No adjustment. needed. Okay. There were no retirement obligations. So no adjustments needed. The management intends to adopt deemed cost exemption for using the previous gap carrying values as deemed cost at the date of transition for PPE and investment property. Are you able to follow? Yes.
Yes, yes,
So deemed cost exemption लिया. So therefore that 1 lakh से capitalize किया हुआ that will also continue to remain there. Are we okay?
yes, yeah,
Yes.
yes.
All right. Fine. Next, the company had an investment in S Limited, which is a subsidiary of H, for 48 lakhs that carried a fair value of 68 lakhs as at the transition date. The company intends to recognize the investment at its fair value as at the date of transaction. As at the date of transaction. Yes. What do you need to do? Yes.
So we will take it at fair value,
You
the
will take it
investment.
at fair value. So what is the adjustment that you will do?
We will increase investment by
You will increase
20
investment and credit.
retained earnings.
Yes. Investment in S Limited. ₹20 lakhs to retained earnings. Acha, by the by, investment in subsidiaries you can continue to account at cost also. Okay. Ind AS 27 allows you to record investment in associates, joint venture subsidiaries at cost. But we have taken the stand that this is going to be your, we have taken the stand that this is going to be at fair value in this question, which is why we are doing a fair value adjustment. Are you okay?
Yes, yes.
Yes. So that takes care of this first adjustment, second adjustment, third adjustment, VAT deferral loan. The VAT deferral loan of 60 lakhs was obtained on March 31 for setting up a business in a backward region with a condition to create certain defined targets for employment of local population of that region. The loan does not carry any interest and is repayable in full at the end of 5 years. In line with Ind AS 109, the discount factor on the loan is to be taken as 10%, being the incremental borrowing rate. The fair value of the loan as at March 31 is 37,25,528. Entity chooses the option given in para B11 of Ind AS 101, that is, chooses to apply requirements of Ind AS 109 and Ind AS 20 retrospectively, as information has been obtained at the time of initially accounting for the VAT deferral loan. So what has happened here is there is a VAT deferral loan. Okay. What is the value of this loan? 60 lakhs. ठीक है? What is this 60 lakhs? What is the meaning of VAT deferral loan? There may be a VAT liability. Now see, are you aware of the latest Vodafone case which is going on in the government? Yes. The telecom department dues is there. Some AGR dues case. Padha hai apne? Have you studied that?
Yes, it was an earlier case. Yes,
It was earlier case. Now also Vodafone has not paid that money, right?
yes.
It is
Not
still
paid.
due to the government. And then what happened? Government has allowed Vodafone to pay it over 10 years because of liquidity issues in Vodafone. Yes or no?
Yes,
And because of that, the market price of Vodafone went up on one day when this announcement came. Yes or no?
yes,
So, can I say that the dues that it owed to the government is effectively converted into a loan?
yes. Effectively, it is a loan. Yes,
It is a loan. And let me assume that it has no interest. है कि नहीं?
yes.
So, is it at fair value then?
No.
Answer is no. Because when you are giving something without interest for a 10-year period, then there is no point in calling it as a loan at fair value. Similarly, this is a VAT deferral loan. VAT was payable, it could not pay, so the government said, fine, you pay it over an extended period of time. So that fair value is actually how much? 37 lakh
25,528.
25,528. Yes. $528. What is the balancing figure?
Interest
22 74 472. किसका इंटरेस्ट? वो मेरा इंटरेस्ट नहीं है. It is a blessing that the government has given you. Yes or no?
government grant.
Government grant. It is a deferred grant. It is a deferred grant. Why? Because it is to be spread over a tenure of how many years? 5 years. Over a tenure of 5 years. The deferral loan was obtained on March 20x1 and we are converging on April 1 20x1. Yani ki immediately next day we are converging. If the convergence had to happen 1 year later, we would take 1 year's amortization to retained earnings and balance would remain as your closing balance. Are you able to follow?
Yes, yes,
Yes. मुझे आज deferral loan मिला, कल आई एम कन्वर्टिंग टू Ind AS. So therefore पूरा 5 year अभी भी बाकी है. So therefore I will not do any amortization now. But if this had to happen 1 year down the line, then I would have to amortize 1 year and I will keep balance of 4 years. Are we okay with this?
yes, yes.
Yes. Okay, fine. Next. ESOP reserve of 20,000. The company had granted 1,000 options to employees, out of which 800 have already vested. So 1,000 options, vested 800, not vested 200. The company followed an intrinsic value method for recognition of ESOP charge, recognized 12,000 towards vested option, 8,000 recognized 12,000 towards the vested options and rupees 8,000 over a period of time as ESOP charge and a corresponding reserve If fair value method had been followed in line with Ind AS 102, the corresponding charge would have been 15,000 and 9,000. Okay, so therefore, under AS, the expense was how much? 12,000 in respect of 800 employees. And 8,000. 12,000 and here it is 8,000. Okay. Expense and corresponding reserve. Are we okay with this?
Yes.
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 This is based on intrinsic value. Ind AS, what is this value? It is 15,000 and 9,000. This is based on fair value. Okay. Now, the company intends to avail Ind AS 101 exemption for not restating ESOP charge as per previous GAAP for vested option. Right? So therefore, here avail exemption. Therefore, no entries to be passed. Yes or no? Correct?
Yes. Yes. Yes.
And here, can I avail exemption? Answer is no. These are not yet vested. You will have to move it to fair value. So entry will be retained earnings debit 1,000 to ESOP reserve 1,000. Did you follow?
Yes. Yes.
Any doubts? Are you able to correlate what all we have discussed so far now?
Yes. Yes.
Yes. Then, cumulative translation difference. The company had a non-integral foreign branch in accordance with AS 11 and had recognized 1 lakh as part of reserves. On first-time adoption, the company intends to avail Ind AS 101 exemption of resetting the cumulative translation difference to zero. That means they want to make FCTR zero and start accounting as per Ind AS 21. Remember, FCTR you cannot take previous GAAP. Yes? All right. I
Yes.
hope you know that.
Yes. We
You
can trace.
remember FCTR, either I do a full restatement or complete reset. Only two options are there. There is no
Yes.
third option. Okay.
Yes.
All right. So therefore, you opted to make it zero. So entry will be FCTR debit 1 lakh to retained earnings. 1 lakh. Is it okay?
Yes. Okay.
Yes. So with that, I think we have completed all adjustments. What I want you to do for homework is, I want you to prepare the balance sheet of this company. It's very simple. You have these items, you have the journal entries. Go on giving double effects. You will get the opening Ind AS balance sheet as on 1st April 20X1. Any doubts?
No. No. No.
No doubts? Okay, so
No.
that takes care of illustration 16 complete. Okay, so I have taken you through all the adjustments. Okay, next. Okay. Next, I think, let me see. Yeah. So with that, let us conclude then today's class. What is left for tomorrow is just 2 points, 3 questions. Yeah. So I think we are done for today. Quite comfortable. Okay. Any doubts you have?
No, no, clear. As of now, clear.
All
Yes.
clear?
Yes.
Okay. No doubts. And do I have anything here? Nothing here. Okay. All right then. So with that, we conclude today's session. We shall again resume tomorrow to close up this chapter. Okay. Fine.
Okay. Yeah. Thank you
Thanks,
very much.
everyone. Thank you.
Thank you. Thanks.
Yes. Session concluded. Yeah. Thank you. Thank you. Have a